my show. I want to thank everybody for tuning in today. I think it's important to make sure we stress all the opportunities that we have in the marketplace today. Today is a nice gloomy day. I decided to do it from a different position and different area in the building. At the same time, I totally destroyed my watch list. After starting it back in February, going all the way until last month, the end of July, a lot of the stocks that I had chosen, a few are still on the watch list, but I wanted to do something different because I think what ends up happening at times is that you may not be familiar with how a person constructs a watch list. So that's what I wanted to go over today. How I'm going to actually construct my new watch list. How would that impact me? What are some of the things that I do? Now I'm going to tell you, if you right now on YouTube and you're watching this show, there is so much information that people are drowning in it. You say you want to look up a watch list, you're trying to get some pointers. Let me just tell you this for a disclaimer. The show that I do is for me. Now, keep in mind that anything that you do, make sure you do your own research. But since so many people are drowning in information, you got to understand that people are starving for wisdom. There's so much information on YouTube. I mean, you can go anywhere and everywhere. You can watch hours and hours and hours. But at the end of the day, I just tell you, you're going to find out very quickly that there's so much information. Like, where do I even start? So let me just tell you how I started. One of the things I used to look at when it came to me building a watch list was being very, very direct. In the body of this YouTube channel, I put a lot of information in there. So it kind of gives you some steps of what I do. So if you want to know those exact steps to a T in order, it is in the body of the the YouTube. So let me just put that out there so that everyone knows it. Don't forget to like and subscribe if you haven't, so you can always be updated. For me, I looked at investing a little bit different. I understood that I can go and have a financial planner. But I actually did something early on in my life where I had a financial planner and I wanted to compete against him. So I used him as a buffer. He built a portfolio and I built a watch list. He consumed money once a month. It was direct. It was actually removed from my checking account on the first of every month. And I actually took the same thing on the fifth of every month and I actually moved money into my TD account. With that being said, I began to learn something about his views and mine. And I didn't really ask him too many things. He built the portfolio based on the rule of 72. 72 means this: you ask what you want to get an annual return in a 12-month basis. Take whatever that percentage is, whether it's 2, 6, or 15 or 20, divide it into 72, and it'll tell you how many years, what you get before the decimal point, or years, the number right after the 10 position is going to be your months, and the ones position is going to be the days. So let's say, for hypothetically speaking, it came out to be 10.15. That's 10 months. I mean, it's 10 years, 1 month, and 5 days before my money would double. That's the rule of 72. Take whatever that percentage is, divide it into it, and it'll tell you the years, the month, and the days. Now, with that being said, one of the things I learned is that it was taking around 12 years for my investments to double based on the rule of 72. And that means that it had to consistently annually hit the same number every year for those amount of years. Well, I took something different. I said, okay, I understand what he's doing. Let me take the approach and let me do what I'm going to do. And I decided to say, I just want to look at making income. I want to take this opportunity with all the information out there. Back then, in the early 90s, they had chat rooms. I wasn't going to go in any chat rooms. I specifically want to do this. What companies and industries do I want to learn? That was it. I just want to know what companies. There were so many companies out. Now, I'll give you a little hint. At the time when I was learning all of this, the social media platform that everybody was on was like 3. I'm going to tell you what they were. They were, at the time, it's going to sound funny, but at the time, one of the platforms was MySpace. That's how, when I first got in this, MySpace was the number one, not Facebook, not Twitter, none of the stuff that we see today was even around. It was MySpace. The other social network was called Mejente for Spanish people. And then there was, I think Mejente also had an off brand called Black Planet, but it was MySpace overall. So I didn't want to look at nobody's MySpace. I didn't want any advice. I just wanted to know what I had to do. So this is how I constructed it. I began to look around and literally in my house and look at all the products that my relatives and I were buying. And based on that, I began to just type in the name of that company and say what they traded. At the time, Black & Decker was a company that was publicly traded. Another one was Sears, Reebok. At the time, actually not Reebok, I'll take that back. Even though Reebok was a popular, it wasn't Reebok. But it was Sears, it was Black & Decker, and it was another one. and you probably known this for a while. It's not an old company. I mean, it's an old company, and that was Xerox. Kodak was another one at the time. These were the four companies, and I narrowed it down to the one that I could afford. One of my principles is I look at stocks when I'm building a new stock watch list. I'm looking at what do I have that I can allocate to the stock. One of the key measurements for me and that I had to learn overall was that yes, you can buy one share. If the share trades for $25, you can buy one. If it trades for $50, you can buy one. But I also learned the valuable lesson by doing that as well. Early on, as I started building out my watch list, and I'm going to give you a little clue. This is a clue that most people won't tell you. It was so important for me to look at stocks and shrink down my watch list to what I was able to buy 100 shares of. This has been a foundational principle that I've always used. It's a hard reminder that don't get my head this big. Focus on what I can buy 100 of. Now, you can buy stock. I remember a couple years back, I had bought a stock, and it was Square when it first did an IPO. And I only bought 2 shares. Now, as you know, we go back in 2019, 2020, and it jumped up to $42 to $50 before it went over $100. Square was trading at. And at the time, I only had 2 shares when I first bought Square. Now, when Square moved up, and it took forever for me to make $2, for me to make $3. But I go back and I look, when that stock moved from the $25 price that I bought to when it moved to 40, or from $25 to 30, that's $5. That would have been $500 if I bought 100 shares. But that's not what I was doing. When I first got into the stock market, I was buying 2 of this, 3 here, 4 here. So I was really diversifying what my returns could be. There was no maximization of what I could make at all. So here's one of the things that I had to learn that nobody would tell me, but I had to learn by experience, sometimes observation. And I was like, man, this stock went up, I only make $50, but it took a lot of movement for me to make $50. It's going to take a lot of movement for anybody who buying 1 or 2 shares. So one of my foundation clues is I always buy 100 shares of anything. So if it moves $1, I make $100. If it moves $5, I'll make $500. If it moves $10, I'll make $1,000. Now, keep in mind that my stock watch list got narrowed down to my capabilities. It was not about at all. You know, if the stock is 25, that meant I need to have $2,500. That's taking 25 times 100. That's 2,500. Automatically, I started eliminating stock after stock after stock. But here's a clue, though. I would not buy a stock at all unless the stock was trading for me. The stock had to be trading above $1, because a lot of times you run into these penny stocks under $1. I can tell you catastrophically that you will lose, that I would lose a lot of my money, even though I could buy a lot of shares, more than 100 shares. But when it comes to the New York Stock Exchange or the NASDAQ or the American Stock Exchange, you have to understand this foundational truth. It's called the regulation. Any stock that starts trading under $1 falls underneath a category, means that they're going to get a warning by the American, the NASDAQ, and the New York Stock Exchange that they are not in compliance with the exchange. So a lot of people don't realize this. They end up buying a penny stock. I had a friend of mine who, at the time when we first started, he loved buying penny stocks. And there was times he had some success. It almost provoked me to, buying something under $1. But most of the time, he got a lot of reverse splits. How does that happen? When you're building out your stock list, you want to make sure that the companies that you are actually investing in are in compliance. The same thing it is in anything else that you're doing. You want to make sure that what happens if a light on the road is not on? It's not in compliance. It's going to blink. But what if a person doesn't know that yellow or blinking, the difference between a blinking yellow light and a red light, and it's a 4-way intersection? How do they even know how to function that? And it's blinking yellow for everyone's side or blinking red. There's 2 different philosophies in that regards. Well, if a company is trading anything for $1, there's 3 things you have to keep in mind, because I had to learn this lesson. 1, they have to have a current CEO. Does the company have a current CEO, or they have the CEO been removed? 2, if the CEO has been removed, though they still have 3 underwriters, or 4, depending upon the size of that overall market, they have to have it. And then the last one, how long they've been trading underneath $1. If they've been trading for $1 for a while, I'm going to tell you right now, that's looking like that's going to be a reverse split. And I'm going to be honest with you, if most of you have never been part of a reverse split, then you need to also keep in mind that when you're building your stock watch list out, a reverse split it doesn't, again, if it doubles or it reverse split, it does not do anything economically. You're getting the same amount of shares based on the one you had. So if you had 10 shares and it did a reverse split of 10-1, then you'll have one. And the same value when you had 10 is at 1. So that should help you out if you ever get in a reverse split. On the other side of the equation, it's no different if it doubles. If you had 10 and you end up now with 100, it's the same value when you had 10. So it doesn't change anything. It's not an economic, it's just one way to either expand shares or reduce shares and maintain the same value of the current shares that you have. You're just going to have a little bit less if it's a reverse split, or you're going to have more. The reason that I gave it as a precursor, because when you're building your watch list out, one of the things that you need to make sure that you do is you're looking at stocks that you, at least for me, let me just revert it back to myself, not necessarily tell you, but for myself, is I'm looking at stocks based on what I have. Can I buy 100 of it? And if I can't, I'm going to keep adding money to my broker's account, and I'm going to keep looking at that. I'm going to keep focusing on the companies I want to learn in the industries, because this is really a marathon. It's not a race. And from February 1st until July 31st, several of the stocks that I picked on the list hit their numbers, and some shot through the numbers. The positive thing is that when it comes to stock picking, it has to do with your worldview. What's my worldview? I'm a growth guy. Growth means I love new companies that actually hit the market versus mature companies. I have a greater upswing on a growth company that IPO'd within the last 5 years than I do have on a company that's mature. And the reason for that is that growth companies always function on interest rates. The lower the rate, the better the company is for financing, because they're not really making profits. How they actually run their business is they're running their business from using credit. That's right. You know, a lot of people right now living their life off credit. They got credit cards, they have line of credits, they got HELOC loans. So their entire life is being used off of credit. Now, not everything, not the entire aspect, but most companies are, though. They, between shareholders' money and then using the line of credit that they have access to through the selling of their shares to the general market, or through any type of offering that they're offering, whether they're doing warrants, or they're doing bonds, or they're issuing additional shares, they're getting it sold to new underwriters who have the first right of refusal to acquire more shares in order to capitalize the company. So let me go back, and it's Black & Decker at the time. It was Black & Decker and Sears Roebuck. And these were the two companies that I began to put on my watch list. And for most people who are inexperienced as myself, and I was going against my financial advisor. My financial advisor was actually buying mutual funds. He had me buying mutual funds at the time. So they were a non-equity stake. And when I started my broker's account, I began to go after equity, which is different. Because if I did have a loss, one of the things I did understand, if I had a loss on a 12-month basis, I could actually write it off on my or my 1040 tax return. Today, if you base it on today, that's line item 13 on your 1040 form, line item 13. That's where you'll write your 8949 form, which the IRS allows, at least for me, you need to talk to your own accountant to make sure that they tell you correctly. But far as for me, line 13 on my 1040 is where I will put those losses, and I can take up to $3,000 in losses a year. Now, you may be on the other side and find yourself in a situation where you cannot, because you just made profit. Well, my first year was a year where I actually bought a few shares and I did not have any realized gains or realized losses. So it was a carryover. There was nothing I could accumulate. But my only goal is, when I do a watch list, is to make income in a 12-month basis. And this is one of the other ways that I did it. I looked at what I made a year, and I wanted to take 10% of what I made a year. And I wanted that 10% to generate additional income without no. That's not something that anyone was talking to me about. It was something that I made. One of my choices was, I had a calculated decision that I was making. So my whole ideology was, okay, if I can actually take 10%, now 10% is going to be important. So if I was looking at spending $2,500, we're at a $25 stock or less. So anything, if I made $25,000 a year, 10% is $2,500. So my goal was to actually, my first year, take 10% of my income and then grow that by 1% of my income every year. So I would have took $2,500. I would have made 10% of that. And I'm trying to make 1%. So I would take my income, what was 1%, and then take 10% of my income to make that happen. So if I was to say that a different way for any of those guys who didn't understand me, is this: if I made $25,000 a year, and out of that $25,000, 1% of the $25,000 would easily be $250. So my question to myself was, if I take 1% of my overall salary, and I take 10% to utilize to make 1%, that means $2,500 had to at least make $250. What I began to learn very quickly was $2,500 to make 250 was I was using too much money. Period. That's the first thing I learned, because using 2,500 to make 250, 10% was too much money, because I couldn't make $250 at using $500 or even using $1,000. I didn't have to use 2,500. So I learned that very early on in my career, as discovering what it was for me to make income on $2,500. What I was able to find out, and that's even using the $2,500 and then buying a stock, holding it, and I base everything on the annual rate. But when I'm building out my watch list and I put up $2,500, what I actually learned was I was able to buy 200 shares and 300 shares, not just 100, because 10% of my income bought more than 100 shares. Now, that also allowed, the reason I understood that, because I was looking at Sears and I was looking at Black & Decker. Now, Black & Decker at the time was cost more than $2,500. Now, my salary at the time was a little bit higher than that, but just kind of give you a second for this example, is Black & Decker was more than $25 a share. So I could not buy Black & Decker. I kept it on my watch list, and I put a little star by it, and I would look at it once a week or maybe twice a week to see and I hope for bad news. I know that's going to sound messed up, but I was praying for bad news because I really wanted to buy Black & Decker. At the time, it was probably one of the number one tools that was around the house. It was affordable, it was consumer friendly. It wasn't like DeWalt. It definitely wasn't at all like some of the major brands that you see today that has been around for a very long time. It was affordable, it was cheap, and that was one of the reasons, because most of the power tools around the house was Black & Decker. And you probably would have found out too if you looked at your parents. Black & Decker was a tool that Sears Roebuck was selling at an affordable price for a family that's middle class. Well, what I learned from that transaction was that Sears got bad news. Now, everybody knows JCPenney's was another one that I looked at, but it was too expensive for me to actually acquire it. Now you look at it today, where's Sears? Where's JCPenney's? And that's another thing I tell people. When companies mature, it's just a matter of time before they go out of business. Once you look at a situation where companies mature, every company has, give or take, depending upon if a company's in the growth sector and they're not stimulated by government money will keep a lot of businesses around that probably should be gone by now, just in general. So when it comes to my watch list, let me show you what I would do. And I'm just gonna, again, I gave you a couple of clues, it's in the body even more, but let me just go into two details. It was all about taking 10% of my income. I based my entire position of life based on 10%. I give 10% of my paycheck to the Lord, and I gave 10% to actually generate income. And the whole reason that was important for me, to be very honest with you, was I needed to test the theory of the financial planner that I was working with. And I'm gonna just put it out there because he's not going to deny this. His name was Stephen Hagerbrook. At the time, he was working for Prime America. That's right. I'm putting him right out there. I haven't worked with Stephen in years. I had to fire him, to let you be honest with you. I had to no longer deal with him because I was able to destroy the returns. But the difference that I learned was that I was never on my 1040 when I was buying mutual funds versus when I was actually taking stock positions, that the 1040, anything I bought directly myself and it was equity, I was able to show that as income in that year. And I began to notice something early on, that wealthy people don't duck income. They increase their income. You hear the people on the billionaire list, they're constantly increasing their income. Now, let me tell you on the flip side to it, the average middle class person or the person who has a degree is constantly deferring income. So that's two different extremes. You have a guy here who they constantly growing on the billionaire list, or back then it was the Forbes rich of millionaires. Then it was the Fortune 250,000, actually 250 million. Then the Fortune 500. Then so the list went to now it's a billionaire list, and then we had seen our first $1 trillion company. It's not that many $1 trillion. I mean, it's nobody right now. It's $1 trillion. They're still just billionaires. That day that comes, that'll be interesting. But from a standpoint of understanding that all the wealthy people you constantly heard about, they're making more money. They're not deferring. So I began to notice a disparity just by looking at my statement. Every 90 days, I would look at my mutual fund statement that I was getting from Prime America, and I was seeing Stephen Hagerbrook's fees. On the flip side, I was also looking at the money that I was making in the realized gains in TD. And I was saying, wait a minute, this is taxable income. I was getting hit on 20% capital gains. So whatever money I made, if I made $1,000 off of using 1,500, and yep, it went up to, that went up $1,000. One of the things I had to learn was I needed to take $200 off that 1,000. 800 was profit, $200 in federal taxes had to be paid. I had to look at the state taxes. I had to also take that into account. By the time it was all said and done on $1,000, I was pretty much pocketing around $688 after I paid my taxes and everything that needed to be paid on that $1,000. And I learned that, but I made income. So my original principal generated income. At the end of the first year and end of the second year, I actually got an income statement from TD Ameritrade that I had to file on my taxes. You know what I got from Stephen Hagerbrook? Prime America? A statement of fees, no income. Anything that I did see in the mutual funds that appreciated was not claimable on my 1040. Even though the mutual funds was actually buying, wasn't claimable on my 1040. I remember talking to him and asking him, say, hey, listen, I have a question. I got this TD statement here and I got this. Can I file on my taxes? He was like, no, this is deferred. And I said, okay, but you didn't defer your fees. Here it is right here while I'm going through. And at the time, when I was trading stocks at the time, just so you know that right now, the way that stock markets make money or any platform makes money is through order flow. Okay, just so you understand that. The price that you see of the stock is not the actual price of the stock. So it's a markup. Like when you go to the grocery store, they're getting that for them having the right to be able to put that on the exchange. It's a markup. So that's important to remember. You be thinking I bought this at $7. Trust me, if the price is $7 is not the actual price, because how does TD make money if it's free to you? It's asinine. It's because they do order flow. They delay the order. The numbers are actually maybe off. Sometimes you see it in the spread. The stock is trading for $7 and then it says $7.28. There's a 28-cent spread. So that should tell you that there's a markup within itself, especially if you go and you buy it for $7.10 and the price don't really adjust on level 2. Well, with that being said, I'm gonna stop saying that too, but just overall, what I had to learn was all the nuances of everything around the market. So what took place? Well, Stephen told me, well, that's different. What you're doing, he says, the license I have, I can't do. That was one of the most important factors that I had to learn. I had to learn the difference between me taking positions for 12 months and Stephen managing my money for 12 months, that he got a paycheck. And that was when the bell went off. Wait a minute. I'm deferring, but he's getting paid. I'm afraid he would tell me, you put this much money so you can bring it down from your paycheck and you can put money in a Roth IRA. I'm learning all these things about deferment, which actually does reduce my income, but it increases his income. That's when I realized that I wasn't thinking like the wealthy people I kept seeing on the Fort Richards list. I wasn't thinking like anybody else who's constantly going out there increasing their income. I'm doing the complete opposite. And there comes where I learned how to build my watch list. So this is what took place. As I mentioned before, my watch list was built on 10% of my income. It didn't matter how much you made. If I made $100,000 a year, $10,000 was going to be invested. From that $10,000, it had to generate $1,000. The $10,000 is not taxable. That's my initial money I put in, but the $1,000 is taxable. So that meant I made $101,000. Now let me just explain something to you. $10,000 to make 10%, basically $1,000. For me, that's an insult. But for others, it makes sense. To make 10%, for individuals who are taking a long position, even if they make the 10%, because I will give you another clue. One of the things I also realized was not to get caught in the dividend purchasing position where I would go out and I said, well, I'm gonna get paid through dividends. So I'm gonna buy stocks that pay dividends. That was another lesson. So as I'm building my watch list, I'm gonna tell you this, I'm looking at growth. And as I'm looking at growth, I am not concerned if the company for me pays a dividend or not. It doesn't have to pay a dividend. Matter of fact, I prefer it don't pay a dividend. That's for me. Someone else may do it. The reason is most mature companies will pay a dividend. Not early stage companies, but most mature companies will pay a dividend. On the flip side to that, mature companies pay a dividend, but a dividend, when it does pay it, I had to learn that if the stock is trading for, let's say, $20, and the dividend was 30 cents. You can expect that stock to be down at $19.70 if there's no additional news, if there's no growth news. I expect it to go down because the 30 cents they pay you in dividend is for the price to go down by 30 cents or more, depending upon what's coming out. So, some of those factors about just buying stocks to pay dividends, it's another reason. There has to be another factor. It needs to be growing. It needs to be have other products. So I just focus on straight growth. I'm a young man. From that position, I'm looking at companies that went public within the last 5 years, and I'm looking at 10% of my income, and then my income has to make 1%. I found out one of the other clues that automatically a lot of the stocks were making me around 40%. So I was able to make $4,000 on 10 grand, and that didn't happen by accident. It wasn't even a mistake. I'll be honest with you. It's actually what I didn't realize at the time was that I was tapping into companies that had great growth plans. And even though I didn't know that at the time, because I made an investment into it, I began to grow, it allowed me to understand this factor here. There are growth companies in a certain area that we currently have that the government wants to be in because it's a new employment industry. So here was my second clue. I had to look at companies where the government was looking to move new employment. So I'm looking for growth and I'm looking for new employment. I'm looking for growth, a company that's went public within the last 5 years, either now in the last 5 years, and the government wants to move the new employment body, the people who will be getting jobs in this industry. So what the government was looking for new employment, what's the sector? Well, in 2023, one of the things is the new sector actually is technology. That's been this way for ever since I want to say real technology push started really in 2000. And it's been that way for 23 years, the technology. Now you see social media platforms came up. That was a push the last 10 years for these social medias where the government was behind them. Now we're looking at solar. You see that being a factor. We also see in the education and the hospitalization area, the medical field, in other words, biotechnology, growth in defense, certain companies that have defense, other companies in consumer goods, that growth. So as of today, as I strip down my portfolio and I look at it, and I'm going to pick just two companies, and I had to make a decision, automatically, industries I want to learn will be one. Since I'm starting all over, I'm going to just tell myself is that the government right now is really pushing towards companies that are in the space of renewable energies. So that puts me to kind of look at what companies, as I build out my watch list, have renewable energies or are going to be what they say environmentally friendly. What are they? The second one what I'll be is right now is since we came out of COVID, they're already planning for a new medicine to be developed, synthetic medicine, not necessarily, and that's the reason, because synthetic you can patent and you can sell on the market and then you can have a license on it. That's not something natural. I mean, if it was something natural like that, and I just jokingly saying like green tea, one of the things the government is going to say is that, yeah, you can come out with your brand, but green tea, anybody can come out with green tea. So that would be considered, what they call a generic product at that point, other than the name. I mean, you could just wrap it up with toilet paper and say it's green tea, or in a cup with no name on it and it's generic until you label it to be something and then you develop the brand around it. So as far as today is concerned, let me just say I'm going to start my watch list off in those two areas. Renewable energies. Can I find a stock in renewable energies? And second, can I find a stock that's going to be in biotechnologies? Here's another thing that you'll see, bioengineered. So we're looking at that. I mean, now they're making all of these products that's definitely not coming from wild. It's not coming from any animals running around the wild. It's coming from tissues in the lab. So I'm going to take my science background and I'm going to start my watch list off at looking at these company stocks. Now, you may say to yourself, well, that's different. He's going into biotechnologies and he's going to go into renewable energies. I looked at his companies before, and that means I got to be going in this space. I got to take 10% of my income, integrate it to generate more income in a 12-month basis. And then from there, take the position of deciding whether or not does this fit my overall spectrum. So this is the beginning of how I start my watch list. Notice I didn't pick a symbol, not even telling you a symbol. And the reason I won't even be able to tell you that till next week, because I first must set out an industry I want to learn. So that's biotechnologies and then renewable energies. Now I'm a little bit familiar with, the electric cars, electric vehicles. As you know, I had on my watch list Rivian and I had Lucid previously. So, for the sake of starting this all over, the goal of it is to look at these two industries and not incorporate my old. Again, I'm not ignoring the previous watch list, but I'm starting all over. I'm going to practice my craft. I'm going to challenge myself to go in now and dive into this. And I'm not going to include Lucid in this transaction. Lucid's on my old watch list. You go check back, but it's not going to be on the new watch list. Not saying that Lucid is not a company. It was a SPAC deal, but Lucid itself ends as far as on my new watch list as I go through the end of the year and in the beginning of next year, as it took from February 1st. So I'm going to look at it now to the end and just say to myself, these are the two industries I'm going to start looking at: biotech companies, and I'll also look at any company that's in renewable energy, whether it's it could be anything that's dealing with electric. It could be anything to do with renewable itself. It don't have to be electric cars or anything like that, but just anything in renewable. So that's what I'm going to talk about today. I'm going to talk about what I need to do. So one, I have to then begin to contact competition. It's so important that you pick up a phone, and I actually call the sales department. Now I'm giving another clue. I contact the sales department, and I'm going to contact the neighbors. So if it's a small company, I'm going to contact the sales department. I'm going to find out of the company I'm looking at for who their competition is. And I'm going to find out if they're public or they're not public. If they're private, they are private. And once I do that, that's going to be my first step on figuring out where I'm going. Now, for many of you guys, you may be thinking about in this regards. Now, I'm not trying to do all that work, but remember, I need my money to work for me. So I at least got to make sure that if I'm going to deploy any resources of mine, 10% of that money, that I'm specifically doing, that I am doing the due diligence. You do not want to, at least I've learned, it doesn't make any sense to go into the marketplace to look at stocks or figure out what somebody else already found out, and then you get involved in it. Because I'm going to tell you a lesson that I have taught many people in my lifetime. I can go into a stock and I can buy it, and I can exit that stock at a price I have predetermined already, as I've done many, many times before. They're still in the stock. And if bad news comes out, they continue to buy in and buy in and buy in, and they bring their average up. And I'm already gone. I'm on to, and in the process of that, they're not. So they'll find very quickly that they're in a position that they're struggling financially. They believe that, oh man, I picked that stock of shit. First of all, they shouldn't have picked it because that stock was subjective. It was all based on the data that I found. It was based on what money I had, not money they had. And they could have spent more than 20% of their pay in this stock. That's dangerous in the first place because it's really not integrated into their overall income. So they were making a grave mistake by mimicking in the first place. So let me just tell you one thing to do. Don't take anybody's advice. Do your own due diligence. I get it. People say, what do you mean? Well, if you're paying for advice, that means you're paying for somebody who's a financial astute. If you think you can get free advice off YouTube and you're going to make a whole bunch of money off on it, yeah, I'll be honest. If you follow somebody into a trade, people do this with Buffett all the time. They figure out what he's buying and they're buying it. That's what they do. They just figure out what he's buying and he's buying it. And there's a lot of companies who piggyback off of that. But you got to have the same kind of money he has. Period. If you don't have the same kind of money, that's a dangerous philosophy. Second is, do you really understand what his techniques are? Because Buffett buys companies, and if he take a stake, he gets a phone call from the board of directors. You take a stake, ain't nobody calling you, and you ain't calling them. So it is something that we need to take and we need to digest. So when I'm building a watch list, and I suggest, and this the reason this resources that I'm actually offering this today, before I go any further, is this reason here, because there's so much information out there. Everybody is looking for wisdom and they're starving for it. And nobody really wants to tell you the truth. The algorithm for YouTube, I would say this as well. It is not built for wisdom. You're looking for information. A person wants to give information, but it's not built for wisdom. It's literally built for attention. That's the biggest problem I had to learn about YouTube. And if I put content out there and it was wisdom, it really wasn't helping people because it wasn't getting to the right person. So now my goal is to shoot wisdom content, and whoever finds it, they find it when they're looking for it. Because just like anything else, you have to be looking for it. If you're looking to be entertained, I'm not going to show you a bunch of screens, and you see me actively trading in front of you. And the reason for that is, it's not that I can't do it, but the reason I don't do it is because that's going to make you have FOMO. You have to be able to utilize the money that you have available to you without anyone provoking you into emotion. That's dangerous. It is. I mean, if you're a business owner, I give you another example. If the business next door to you and your business, and you standing side by side, and this is an ice cream shop and you're a barber, you have people coming in to get their hair cut. Some of the people that come get their hair cut may come in with an ice cream, may not come in with ice cream. But imagine me as the ice cream store owner thinking I should have the same benefits as a barber. I'm not going to win that battle. The same way during the summertime, the barbers, people may come in with ice cream or not, but during the summer, I have a greater advantage, but during the winter, I don't. So I just encourage you guys to not make that fundamental mistake. The other thing I'll tell you is this. This is a marathon. Please do not take it in position that it's a race. Don't compete against your own pride. Matter of fact, lose it. Go do observation. Don't even fight it. In order for you to be astute, in order for you to understand an industry, it's just like going back to school. You're going in, you're going to learn about it. You're going to learn a lot about the industry. You're going to learn about the misnomers of the industry. You're going to know about some things positive. You're going to find out. If I'm going into biotech, chemistry, I'm not telling nobody else, but for me, chemistry has to be, I'm strong in chemistry. I did very well in chemistry. So I need to see what that chemical is supposed to be doing, period. For someone else, biotechnology is, let me figure out what's going on. And I just jump into that. Well, biotechnology has taken a lot of people's money. Let me just tell you, because there's drugs. Then when they go into stage 1 and stage 2 and stage 3, along the way, before they even get approval, they get a stage 1 trial, very limited information. And you don't understand that, you can really invest in a company and lose a lot of your money behind that. Stage 2 and stage 3, and then just approval. And then how long do they have the competitive advantage that they don't have to give permission to a generic drug where they can capitalize it? Or is this drug going to be bought out by Johnson & Johnson, by Pfizer, or maybe by another company over that's part of the FTSE 100? Those things all play a factor. Do I see this drug just being, or this bioengineer, whatever it is, does this look more like it's going to get approved, or is it going to get acquired? That's a whole different philosophy. I didn't learn that overnight. I learned that by not knowing that. That's how I learned that. So there are certain drugs that the FDA approves of, the Food and Drug Administration approves, and certain drugs that they're willing to explore. Right now, they have given Beyond Meat, which is a biotech company, bioengineer company, approval. They're giving some new companies that are in the bioengineer category to come out and test in different restaurants. It's not the same thing as a medical stage 1 and stage 2 and stage 3. But when you're building out your portfolio, and if you listen to me, I gave some serious clues in this video. You have to make sure that you're understanding the industry. So when analysts come on, because around that company, for example, recently there have been news in other companies, and those companies have nothing to do with what I actually hold in my portfolio. It literally doesn't. Yet the overall NASDAQ and in New York rose behind these companies. But the company that I was invested in didn't play a factor. Their earnings didn't even come out yet. So what happens if you take the information from the overall market and from the biggest companies that make that benchmark in that overall market rise, like the NASDAQ, the ones that's pushing the NASDAQ up or pulling it down, and that becomes the precursor of your decision making, but it has no nominal effect on the operation of this company at all. These are the clues you have to do. But on today, I just wanted to tell you that when you start to build a watch list, you have to pick an industry and a company. You don't pick a stock, you pick a company. The stock symbol is attached to the company. And come next Wednesday, I would have determined and started doing my research on the renewable energy sector and what company I'm going to pick. And at the same time, bioengineer and what company I want to pick. I'm going into 2 categories that I don't normally talk about, but doesn't mean I don't invest in them. And I hope you will enjoy. Take the opportunity to like, subscribe, share it with a friend. It's all good for entertainment and also for wisdom, because as I said before, there is a world that is drowning in information, but it's not wisdom though. The algorithm loves to look for people to be entertained, but not give a person wisdom. If you're looking for usable information, then I definitely tell you that don't forget to like and subscribe. And I hope that this year for you, as you run your marathon, you're profitable. I'll see you next week.